If you're a small business owner and you don't know your break even number, then this video is for you. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audit, and taxes, and I'm all about helping you take control of your money by living smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And be sure to check out the blog site where we post every Monday, Wednesday, and Friday. Today, I'm going to walk you step by step through how to create a break even analysis and explain why this number is critical to your business's success. Let's get into it. So, you may be asking yourself, what is break even? Break even is the point where your revenue equals your expenses. You're not losing money, but you're also not making a profit yet. Anything above that number is a profit. To calculate your break even, you need to know three numbers. And those three numbers are your fixed costs, your variable cost per unit, and your selling price per unit. Let's break down each one. So let's start with your fixed costs. Fixed costs are expenses that don't change. Think of things like your rent, your insurance, those salaries, the software subscriptions. Those are going to be your fixed costs. Now, what is your variable cost per unit? These are the variable costs are those costs that increase with each sales. So the more you sell of an item, the more material you're going to need, the more shipping is going to cost because you're processing more, the more processing fee from the bank because you're making more sales. Those are which are variable costs. Their increase is really dependent on how much product you're making and selling. And then your selling price. That is what you charge your customers. Let's walk through an example together. So, in our example that we're going to use, we're going to say our fixed cost is $20,000. And remember, fixed costs are those expenses that don't change. Our variable cost is going to be $30 per unit. Remember, our variable costs increase with each sale. So they're really dependent on how much we sell and how much we're producing. And then our sales price is going to be $75. And that's going to be what we're charging our customers. So first, we're going to calculate what is our contribution margin. So the formula for our contribution margin, which is the first thing we're going to calculate, is going to be our selling price minus our variable costs. And that's going to get us to our contribution margin. So in our example, our $75 selling price minus our $30 variable cost is going to put us at a contribution margin of $45. Next, we're going to take a look at our break-even formula. And this is nothing but our fixed costs divided by our contribution margin. Remember, in our example, our fixed cost was $20,000. And then we just computed our contribution margin, which that formula again is our um, selling price minus our variable cost. And that was $45 if you remember. So that comes out to exactly 445 units. So $20,000 divided by $45 equals 445 units. So what does that mean? That means that we must sell 445 units in order to break even. And what was break even again? Remember, that's at the point where we're not losing any money, but we're also not making a profit yet. It's our break even. So let's take a look at the break even revenue. If we take our units that we have to sell, which is 445, and we times it by our selling price, we have to bring in a revenue of at least $33,375 in order to make a profit. So, why does a break even analysis matter in your small business? A break even analysis in your small business can help it to set realistic sales goals or sales targets. It can help you to evaluating your pricing. It can help you to make better hiring decisions of when you should hire and when maybe it's not a good time to hire. And it helps you to plan for growth within your business. And most importantly, it helps you to understand the risk with your costs versus what you need to sell. If your break even point is too high, you either need to reduce costs or increase pricing. Now, what are some of the most common mistakes I often see business owners make? When running their break even analysis, oftentimes business owners will forget to include their own salary. I know you got a lot going on, but remember, take the time to include your salary into that break even analysis. They often underestimate costs. For some reason they don't have a really good sense of the reality of what the cost will be in order to make their products and bringing them to the marketplace. Or they never update their numbers. It's really important, especially in a hyperinflationary periods, to make sure you really understand your costs and know how much where your number what your numbers are saying to you. It's all a language. Your break even point changes as your business evolves. So, what are our key takeaways? Remember, as a business owner, know your numbers. You want to understand what your cost is, where your pricing point is at, and how you can use that to drive your business. Remember, you don't just want to set your break even analysis and then forget about it. You want to review it annually to make sure you're updating as your business grows and to help guide you. And remember, your break even analysis will help you guide to make better and more informed decisions within your business. If you found this video helpful, hit the like button and be sure to subscribe for more small business accounting advice. And be sure to come back next week when we'll talk about internal controls for small businesses.